Okay, what's going on, guys? It's Mitch here with the Cleary real estate team and Century 21 in Peterborough, and we are doing our market update for October. This is September's statistics that have been accumulated, and similar to last month's show, or last month's update, I am going to give you the bullet points from the story at a glance or the article outline for the blog post that I've written for the website. And then I'm going to expand on those topics. A quick note on that is that in the past, I had a quick outline for these videos. I basically just came on and talked, and it was the recreation of conversations that I was having throughout the week. I'm taking a bit more of a structured approach. I've taken time to go in and pull a lot of specific thoughts and information and put them into a written blog post. In my opinion, you're going to get a more clear and in-depth vision of what's going on out there and sort of my thoughts on things if you go and read the written format of that. I know not everybody's going to choose to do that, but I just want to say, man, I put a lot of work into this blog post, and I'm going to continue to try and improve that. So at very least, if you care to go over to the website and check it out and give me any critiques on the formatting, that would be great. But I do think that it's some quality posts that we're going to start to put out there and really trying to put out stuff that is top notch in terms of the value that it offers for that blog content. So I'm going to link to that down below in the YouTube and podcast description. It's just mitchcleary.com, and then the insight section, you're going to see it there. Go check it out. I think you're going to like it if you get any value out of skimming the written format of things. And there's going to be some stuff in there that I may not have time to cover in this video. Okay, story at a glance. Slowest September for sales since 2012, with sales down 30% year over year. Average sales price of $630,000, down 6.6% year over year. So we've gone backwards year over year. All those gains were wiped, and a little over 1% month over month from $638,000 in August. So down about $8,000 on average in the last month. Showing activity in September was the lowest of the year. 1% monthly moves are drastic changes in the trajectory of the price declines, but could still add up to large annualized losses. Buyer sentiment does not seem as negative as industry experts. Commentary: inventory is basically flat month over month at 2.25 months of inventory, despite weak sales, indicating ongoing scarcity and or sellers withholding inventory from the market. Central bank interest rate commentary increasingly slanted towards further rate hikes. Low inventories currently suggest low selection and competition could return as soon as interest rate signaling flips. Again, I'm going to expand on this in a little bit if this is quite a bit. This is a large outline, so bear with me, only a couple points left. New housing construction starts slowing on lower industry confidence and tighter lending, which will lead to a bleak housing future in Ontario. And then the last point is great uncertainty surrounds the next 6 to 12 months on the macroeconomic picture. So lot to cover there. So I'm basically going to start expanding those points along the linear progression there of how we went through things and how I've got them written in the article. And again, any of this that you want to go deeper on, just head on over to the website. So, okay, first of all, prices. We knew that this was going to be an interesting month for watching what was happening with prices. And really, the question was, okay, this is a big telltale month or set of months of data, because August really gave us the first indication that we might be seeing a bottoming or a trough in the graph. And now, without things going sideways, August was the month really where it looked like, okay, sales are starting to increase. Inventory is actually going down a little bit. The speed that the sales price is dropping is dramatically changing or slowing. And hey, next month might be the first month that we see a straight sideways or a slight uptick. That's what we thought. And now instead, it's just boom, another month of 1 to 1.5% price decreases again. So it leads us to the question: is this the new normal, and are we just going to continue to see this little slug and chug down of prices, or is this really the start of that trough or valley in the image of a bar graph indicating prices? So on to the factors that really play into the prices, and that's the sales activity and the inventory. It's always some part of the interplay between how much sales velocity we have and how much inventory is coming on and keeping up with that, or getting dwindled down, and scarcity is coming about. So sales activity is slow. It's abnormally slow given that we are in September, and this is typically a month where we're going to see an uptick in activity in terms of the end of the summer months. So it's leads us to question, why is that? It would seem to me that most buyers, the sentiment right now is, simply put, that most people are well aware that we're not really truly going to see things lift and begin to rise again until the central banks start to at least signal that rates will be coming down at some definite point in the future. So a lot of buyers right now are just simply hesitant, or not so much hesitant as patient, and in no rush whatsoever, really, to go ahead and make a move. Many that are shopping in a lower price category, closer to the bottom, where things aren't dropping as much anymore, are feeling content to go ahead and make that entry into the market. But most are wanting to know that they're buying at a, what one would deem to be a discount to the market rate out there, to make sure that they're protecting a little bit against what could be, an ongoing soft market in the future here. In regards to inventory, it is peculiar that the inventory has stuck so low. And what I mean by that is that 2.25 months of inventory, that's still historically a really low number. Like categorically speaking, in terms of what a real estate textbook or Wikipedia is going to say on months of inventory, and all the real estate wisdom out there, is that technically it would actually still be considered a seller's market, even though we know that's not true by any sort of real world qualifiers. Just looking at how much prices dropped, how much the days on market is growing, and how little showing activity there is. It is not a seller's market right now, as far as I would call it. But technically speaking, 2.25 months of inventory is still very low amount of inventory, and that's simply the amount of active listings divided by the amount of sales in the prior month. Giving us that if all new listings stopped coming on tomorrow, it would take 2.25 months to burn through all our standing stock. So even with such negativity, such bad sentiment out there from all the industry experts and really all the headlines, you get really a historically low amount of inventory, and it leads you to ask, what does this mean? And it seems that a lot of sellers that have discretion over the time that they're going to sell, when they're going to sell, if they don't have to sell right now, they're not bringing their product to the market. And a lot of people seem to be of the mindset, whether it's right or it's wrong, that things at some point along the line have to improve here. And if they don't have to sell for any given reason in the next 3 to 6 months, that a lot of people are content to be patient and see what plays out here. A lot of that's being fueled by a full awareness of the true unit scarcity, just the pure arithmetic of amount of people, populace in the country versus the amount of homes really truly available. And that ties back into record immigration numbers this half of a year and this quarter, and ongoing issues with new construction starts. So we have been plagued for some time now. Everybody's well aware of sort of all the red tape and housing crisis factors, labor shortages, increased product scarcity in terms of the building supply inputs. But then further to all of the regular stuff we already had going on with troubles bringing housing product to the market that kept up with the actual population growth. Now we've got a new issue, which is because of this, the extremely negative sentiment and banks starting to clamp down a little bit on their lending practices. You're starting to see development loans be pulled back and developers pull back on new project starts because of the uncertainty of the future. And it's starting to lead to a couple of colliding factors where we have this record population growth, and we have projects being sort of parked away that could be bringing new inventory to the market in 1 to 5 years from now. And we're going to end up with a real bad scarcity picture as time goes on, as if it's not already bad enough. But nobody really knows how that's going to play out in the price equilibrium of things. Part of the reason it took me so long to try and write this blog post is because when you try and think about this stuff in a linear fashion, first this, then that, in terms of how you come up with a conclusion about what the next course of action is going to be for prices and what actions people should take, what actions buyers or sellers or anybody looking to acquire a home or make a move in this market. When you start to think, okay, how do I break this down and just go A, B, C, it's almost impossible because the equation for home prices is so multi-factored. It's if what you're trying to solve for on one side of an equal symbol is housing prices, on the other side of that is not like a 2 + 2 equals. It is a massive, moving, really convoluted ball of information, and it includes such things as total immigration and population growth due to immigration, and it includes net outflows of populace to other provinces, as we're seeing a bit of a flight from Ontario over to provinces such as the Prairies and Alberta, where there is cheaper real estate and abundant jobs. And you're also factoring in the economy in general, not just interest rates, but all things to do with liquidity and lending practices, such as possible extensions of amortization periods, possible removal of stress testing, or changes to any regulatory pieces surrounding the lending puzzle. You're talking about economic optimism, wage growth. You're talking about socioeconomic factors. For example, when COVID hit, how many people left the GTA? That was totally unpredictable. But we also have the ongoing factors of the price of gas and people's willingness to take on long commutes, such as living in Peterborough and working in the GTA. You have announcements about major transportation infrastructure. For example, even if the gas equation doesn't get figured out, how you could have a major announcement about railway transport to Peterborough that could help people make a decision saying, okay, I'm willing to eat these gas prices for the next 5 years if I know that definitely commuter rail is coming and I can support my job that way. On and on. You've got energy prices. You've got, does it real inflation actually come down? Do we solve the bottlenecks of the energy supply so that these really high fuel prices help bring down the cost of goods and services generally, including the price of your strawberries and everything else that you buy? It's possible that to no doing of the central bank's side of things alone, where they're trying to dampen demand by increasing this interest rate, that we see a little bit of easing on the inflation side of things through other means, which is just basically the increase of the supply of goods, and namely, I mean, really specifically, energy is the big one at this point. But all of these things play in. One quick picture I would paint is that people point towards, well, interest rates are definitely going to increase at some point in 2023, or at least that's what the main theory out there is right now. And the thing is that we don't know how much they'll drop, when they'll drop, or why they will drop, because they could be dropped for a number of reasons. One of them is that inflation heads back towards the bank's target of 2%, and la-di-da-di-da, everything's good. All of a sudden, their inflationary pressure comes down, employment is stable, prices are stable, and they can ease their interest rate back into something that they would consider a neutral zone where it's not having negative effects on economic activity, but it's not overly fueling speculative growth and asset inflation. And so there's the one route where they could raise or decrease interest rates based on that they've achieved their goal. They don't want to maintain interest rates at a potentially harmful level for growth ongoing, and they bring things back down, and it's a perfect landing. But then there's the other picture where they keep raising until we have a serious economic event, or for no doing of the Bank of Canada or the Federal Reserves, that we have a massive economic financial event, irregardless of what they do, that manifests for any number of things, such as currency collapses abroad, sovereign default on foreign debts, and any sort of accumulation of the really fragile factors out there of a lot of different countries, governments, and a lot of different countries' populations that have seen their debts absolutely balloon over the last few years and are at unsustainable levels, and we're all predicated on low interest rates, and we're all built on inflating asset prices. And now, when the price is going up on that debt, people are having trouble servicing it, not just in the real estate sector in Canada, but across the world on all types of consumer debt. And we really could just have a global financial event like we did in 2008. And what that would be is a drastically different picture in terms of how much the central banks would have to lower rates, how long they would keep them low for, and how any of the other supporting factors that would promote the purchasing of real estate would be affected. So, for example, if in a regular scenario, the bank drops interest rates from, we're at 3.25% on the overnight lending rate from the Bank of Canada right now. And if that rate goes up another full percentage point this year, which it could, when they go to lower things back down, it's not likely to believe that under normal circumstances, if they get inflation under control, that it should really go much more than below 3. Historically speaking, interest rates have typically been in that range or higher for long periods of time. When you go back, a lot of people, there's charts all the time out there of 20, 30, and sometimes 80-year interest rate charts, even 100 years. But if you go back, there's some available out there. Actually, I can link to one here from a great Visual Capitalist is the website that has basically a 670-year chart of interest rates. And I mean, long story short, we've been in a very abnormally low for long interest rate environment, and there's no reason to believe that we can continue to exist in that state without perpetual systemic inflation. So unless there's a major financial event, what do rates actually come down to when they stabilize? Nobody knows. But if we were to look at historical numbers, odds are it's going to be somewhere closer to 3 to 5% than it is to 0 to 2%. So all of that says that it doesn't lead a good picture to thinking that we're going to get back to our old highs anytime soon in terms of real estate prices of the recent peaks. They're going to be nearly impossible for people to reach in terms of what their incomes are and how far they can leverage themselves via these mortgage loans. But then the second event, like we said, is if there's an absolute financial catastrophe, or if there's a global security event with all the news cycling about Russia, nuclear warheads, Taiwan and China, U.S.-Chinese communications, and if there is anything that creates a collapse of confidence, or that the central banks continue to raise too much too quick and they really collapse just our own localized debt bubbles, and we see a major collapse of confidence in the markets. We see a flight of capital from the financial markets. We see lending pull back generally, and liquidity basically frees up and seize. Then it's likely to believe we're going to see rates go much lower and back into this whole, CPR, emergency life support style of 0 to 2% rates. And of course, that could lead Canadians who are in any kind of positive financial situation to be able to extend themselves again further. But the whole picture of that being considered is it would likely take a long time for those low rates to really totally grab a hold, because this type of recession, based on that type of event, might last longer than what we saw from the pandemic. Really sharp and really quick recovery out of a contraction of employment and whatnot. If we see ongoing employment issues, even if the rates are low for long after a financial crisis event, there could be so much other drag on the factors that play into people's ability to purchase that it could still mean that even with those really low interest rates, again, at some point in the next, year to 2 years, we still don't see the type of price growth that some people seem to be banking on. So that leads me to one of my last themes, which is, honestly, it's my own opinion. I would love to be challenged on it or to hear others' inputs, is that I just don't see real estate being a get-rich-quick scheme in the way that it was over the last 5 to 7 years anytime soon. It seems to me it's going to be much more of a normalized market, the Peterborough and Ontario that we used to be used to, where you would have 1 to 3% appreciation a year. And that's, I'm talking about once things normalize, which were still back then great compounding annualized gains, because you were leveraged. You had an asset that was appreciating at 2 to 3% a year, but it was appreciating that 2 to 3% on the entire value of the asset. So you had a $500,000 home that was going up at 3% a year, but you didn't actually have that much cash in. You only had 5 to 20% in. So your actual cash on cash numbers were still back then acceptable versus many other forms of investing. And it's just in recent years that people have really become addicted or I guess feeling that their goals when investing in real estate should be this buy, renovate, rent, and refinance type of strategy where you have so much equity that it's spilling over and you just keep reusing it. It's likely that those scenarios are drastically hindered over the next, honestly, I mean, as far as I can see, 5 years. But I would love to have further discussion on that with anybody who's got any more developed opinions on it. And lastly, I think that a lot of the conversation right now is revolving around, prices up, prices down, what's the new equilibrium, and how does a lot of conversation cycle back to, well, once things are back to normal, it's such a game of musical chairs. There's so much scarcity because we do have such real population growth and we have such bottlenecks on the construction side of things. Where does this all manifest? Rents can only rise so much until that puts a floor on purchase prices. And then everyone sort of seems to be thinking, when do we just see this thing catapult again? And the more that you really think on it and dwell on it, if wage growth is capped, interest rates are stuck, somewhere in a range of 3 to 5% ongoing throughout the future, and supply is tight and population growth continues. If we can't actually see real estate prices appreciate because people don't have the money to spend, the only other option is that you see the prices maintain or improve slightly, but it's at the consequence of the sacrifice of people's quality standard of living. So rather than someone being able to afford more via lower interest rates or via a new raise or any kind of improved income, what you could have is people being able to afford more by sort of conceding towards intergenerational living and just condensing the amount of occupants per dwelling so that two incomes become one, and those people can then make a larger purchase. So Not that this isn't terribly a doom and gloom thing. I've many times had thoughts on this when I go through homes nowadays with first-time home buyers, and you see the reaction to, albeit the prices are extremely high and they're a large portion of their disposable income. But you see the reactions to some of the homes in this, $600,000 range even, and you can just tell that it's not what they wanted. It's not the story that Instagram and Pinterest painted, and it's not where they think that their entire life savings and their, for perpetuity, 40% of their income should be going to. It just doesn't get them excited. But you look at this, and these are the same homes that our parents were raised in, with families of 3 to 10 plus children. Personally, my father's own family was a family of 10. And like he said, it's not that you shared rooms, you shared beds. and so back then, there just wasn't as much of a bounty of a housing stock. And there's a chance that we get back to a situation like that. There could be a chance that we have absolutely peaked in terms of our housing quality standard of living for the time being, and people have to adjust their expectations downwards, and the vision of the dream home gets significantly revised. And it could take a while to really have some mass buy-in on that. But I do think that we are just in a bit of a new reality. Where there's not a ton of housing supply coming. I don't think meaningful amounts in relative to our population growth, and there isn't new ways to pay for this real estate coming around either. So I think it's just more and more scarcity, and more people willing to accept less for what they're going to call home. And then the final thought is that, it's starting to happen already, but you just see more people fleeing the province and saying, I can't exist in this environment. I can't work at this minimum wage job and afford a house. And so I got to find somewhere that I can exist and thrive and grow a family or whatever I choose to do with any of my disposable time and income. And so you start to see people go other places, and you start to see people opt out of home ownership altogether and just commit to renting. And really embrace a digital nomad style of life. There's so many ways you can make money online now, between freelance, ad campaigns, writing. There's just about every type of administrative service that exists in person is also offered online now. So you're starting to see people take their skill sets of social media marketing, accounting, you name it, and work off a laptop, and then all of a sudden they have no reason other than their family that's keeping them ingrained and embedded in their province. And you see an aging population. There's a chance that as more and more people's parents, once they're no longer in their lives, there's a chance that they're just not as held into this extremely expensive, hard to exist province. So that really negative ending to the show there. So I apologize for that, but I do have to just say that it's not all about prices up or prices down in this discussion. I think you have to put into the conversation the item of quality of living, because I think it is set to decrease in some ways, at least in regards to housing, ongoing, the way that the picture's painted right now. So I guess lastly, everybody, if you are not currently working with an agent and you want to reach out to us and have a consult call, if you're looking to do anything in the next 3 to 6 months, obviously we need to know your specific circumstances, and we're happy to chat about that stuff. I hope that everybody has enjoyed the show. I'm sorry, I know this one ran a little bit longer, but I really got on a rant there, because writing such a long blog post really got me thinking deeply about this stuff, and I just needed to sort of speak on it from end to end. So I don't know if I'll hear from everybody, or I'll see you again until the next monthly market update. But if I do put out any content in between and you want to be notified, feel free to join our newsletter. Again, on the website, you can just click to subscribe there, and we'll get you on our mailing list so that whenever we do put out content, you know about it. And anyways, thanks to everybody for listening, and we'll look forward to talking with you next month. Take care.